Hello, everyone. Today on the final bar, we will wrap the week, our normal Friday routine of looking how the markets have evolved from last Friday to this Friday. Sometimes the wrap the week segment is a bit of an update, just sort of updating the models and everything. I think this is certainly a pivot of sorts. Last Friday, things felt pretty dismal after the sell-off last Wednesday and Friday, pushing the S&P back to its 50-day moving average. This week, reverting back to the upside with fury, with the furor. We'll take a look at all the charts and more. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets using the power of stock charts, using the toolkit of the technical analyst, focusing on price, breadth, sentiment, how all of those are related. And Friday, we get to use the Mindful Investor Live chart list, which is sort of part of my weekly routine of reviewing some of the key macro themes through the charts. And again, overall, if you can keep a consistent routine of looking at the same visuals of understanding how the markets are evolving and focusing on momentum, focusing on what's working and what isn't, overall, I think you're going to navigate any sort of market pretty successfully. It's all about the routine. I was actually talking earlier today with Helene Meisler. We're getting a second season of Behind the Charts, and she's agreed to be one of our interviewees and talked all about the importance of routines. Really excited to share that and many other conversations with you in the coming weeks and months as we get the interviews together. We have some great guests coming through this show, The Final Bar, and it's one of my favorite parts of hosting the show is being able to chat with some fantastic guests. And I was very happy this week. Louis Giannis, Leslie Juflas, Tony Zhang all did a really fantastic job, really thought-provoking charts and comments. Next week, more of the same. On February 9th, which is Tuesday, we have Javed Mirza. Javed's the technical analyst at Canaccord Genuity in Toronto. On Wednesday, the 10th, Clint Cowles, who's at TD Ameritrade in Minneapolis. And then on Thursday, Larry Tentarelli, founder of Blue Chip Daily, joining us on the show. It's going to be a lot of fun next week. Also on Monday, of course, we do our Monday routine of the three directions of the market. There are three approaches: macro, big picture, bottom-up stock picking, sector rotation. So Monday's a good show as well. Let's get to our wrap the week segment. I did want to start, though, with our poll. We asked the poll recently, will the next 10% move in the S&P 500 be higher or lower? Now, it's funny, depending on when you answer that question, the market may have evolved a great deal. We usually put that up on Tuesday or Wednesday. So the last couple of days may have juiced the optimism just a touch or two in terms of what the answers might be. But 2 out of 3 of you said almost that, said the next move in the S&P would be higher. About 1 in 3 of you said lower. And again, based on the weight of the evidence, the latter half of this week, it's hard to disagree with you. I'd have to say 10% higher. If you asked me last Friday, I would probably have said the next 10% being lower. You figure about 380 points. That would put us, around 3,400, 3,350. That would put us back to the 200-day moving average if you sold off. Adding another, 380 points. Puts us to 4250 or so, which would be up here somewhere. That's not that unreasonable. 10% doesn't seem that much when you've had the run like we did so far this week. So 2 and 3 being more positive than negative, I can't disagree with the sentiment there. And again, that's a big change from last Friday. If you listen to the tone of last Friday's show, it was, all right, we're at the 50-day. Here's what a down move further to that might look. This is what I'm putting the bright pink lines around the 3,200, 3,250 level. Just takes a week of reversal. And again, it's not just the big broad market charts that look compelling. It's a lot of individual names. I usually sketch out random tickers as I'm looking at charts and just ideas to dig into more to think about. And I haven't had a shortage of ideas and it's not, it's focused just on large cap or mid cap or small cap. There seem to be actionable charts that if I don't care about the market overall, I'm just looking at individual stocks, I don't think there's a shortage of decent patterns to be looking at right now. And that tells you, I think, a little bit about the overall scenario that we're in. There would have to be quite a downturn to make some of these charts look less positive than they are right now. Let's continue on and go through our wrap of the week charts. Give me 1 second here. I actually didn't have this one set up just yet. So let's go here. Here we go. I don't have the label set up correctly, so sorry, they're going to be jumbled on the left, but I'll talk you through it here. Here's the S&P 500 in black. That's up 4.8% in the last week. What underperformed the S&P 500 this week? Here's the dollar up about 0.5%. The only two that were negative is gold, which was down 1.6% this week. Bonds down 2.5% this week. We talked about rising rates. We've talked about the strength of financials and the potential upside with given a steepening yield curve and higher yields. Certainly seems to be the trend positive in yields, down for bonds, and this week was sort of continuing on with that. Again, here's the S&P up 4.8%. What outperformed the S&P this week? This is the NASDAQ 100 up 5.3%. This is EM, emerging markets, up about 5.5%. In purple, this is small caps up 7.8%. The big winner for the week, crude oil, up 8.5%. Usually I create a second chart using including Bitcoin because obviously it given the volatility tends to be an outlier, tends to skew the chart a little bit. Here's Bitcoin up just over 10%. Bitcoin had been one of those where all of a sudden we're looking at how quickly could we get back down to 20,000 with how quickly it seemed to break down and revert off of that all-time high at 42,000. The chart of Bitcoin, as we'll see here in just in a little bit, has actually held up just fine. It's actually done very nicely. And when you think about something like Bitcoin, I was asked recently about Fibonacci retracements, and this may be the example I use for a little while, which is if you want an idea of how you use Fibonacci retracements on a longer term chart, a 6-month plus chart, Bitcoin's a decent one. As you start with the low in September, you take the high from January, there's 38.2% of the way down. And when you have this confluence of support, the 50-day moving average lining up just beautifully with that first Fibonacci level, that suggests sort of a confluence of support, a more significant support level, and we've bounced off of there so far. And based on what I'm seeing from a technical perspective, certainly seems in good shape to retest at the very least the all-time highs around 42,000. I think when it reaches there, you have to recalibrate a little bit and see where you're at relative to the momentum and so forth going there. But overall, shaping up pretty well, it seems like. So that's what happened sort of leading up to Friday, big picture. Let's talk about how the trends have evolved overall. Just very quickly, I wanted to just update on today's changes. So, the S&P up 4.4%, mid caps and small caps even more. So this leadership in small caps, we're going to see a little later, that long-term ratio, that long-term outperformance, it's not a new phenomenon. This has been going on for quite a while. The VIX almost down below 20 again, just below 21. Bonds, as we mentioned, weaker again today, really just continued to sell off through the course of the day. 10-year yields approaching 1.2%. Precious metals up, gold and silver both rebounding nicely. This long-term uptrend in commodities, which we've been talking about, continuing today. Most cryptocurrencies up today, with Bitcoin up 0.2%. Many others up a more significant amount. In terms of sector movements, you had materials number one. We've talked about the relative weakness in materials, but a nice bounce today for that sector. Communication services number two, and then consumer staples, which is actually an interesting one for number three. On the bottom, you have technology lagging. So the market moving higher, making another all-time high, another closing high, but tech not leading the way, which is a bit of an unusual phenomenon. Financials coming off with interest rates going higher, and then healthcare, you have the XLV just a notch above flat. So interesting to see something like staples up at the top of the list. Consumer staples and discretionary essentially in lockstep, outperforming the market today, up 0.9%. And again, the lagging of technology is sort of a head scratcher in terms of what normally should happen given a market going to all-time highs. Let's finish off this week, wrap the week segment looking at the Mindful Investor live chart list. If you've not seen this before, easy to find it. If you click on your dashboard, go to the, don't worry about that. Click on the articles, the articles tab at the top. On the right, this lists out all of our different blogs. Mine is called The Mindful Investor. And at the top, you'll see this little button that says Live Chart List. That's how you can save this list of charts that we're going to review right now. The first one is a market trend model, which is looking at weekly closing data on the S&P. It has a short-term, medium-term, and long-term components, all built on weekly data and essentially weekly exponential moving averages. To summarize all three of these back positive, the short-term model had turned negative last Friday on the close. I update these every Friday after the close. As of this week and early on in the week, it certainly seemed as if we were going to get a reversal back to the upside. The short-term model back positive. The medium-term model actually never technically went positive. It was really, really close last Friday. It didn't quite do it, and has remained positive. The long-term model has been positive since last June. So, the way I use a model like this is not, as a trading system or anything. It's more of an overall bias with which to approach the market. And when all three of these are positive, it tells you it's a decent time to be looking opportunistically for stocks. That's the green light to be buying good charts and good positions. The daily chart of the S&P has very quickly, from last Friday to this Friday, changed from a potential weakness, a tactical downtrend, breaking below the most recent swing low after breaking down through trendline support and approaching the 50-day closing just right below that level. And the question we had last Friday is, do we get the follow through next week? Do we break down through the 50-day? We did not. We bounced right off it. This is a bullish harami pattern, a long down day, a long up day. The second day's body is engulfed by the first days. So the second day is a little narrower, but still a long up day. And that's a short-term rally signal that really just continued through the course of the week. Today on Friday, we get a new all-time high for the S&P, a new closing high almost to 3,900, nearing that key psychological level of 4,000. Worth noting, by the way, the RSI not overbought. So the market breaking to new highs and the RSI not overbought overall is a good thing, because the move is not over. That tells you there's potential for more upside there, more gas left in the tank, if you will. If we would roll over next week, you'd start to get a potential bearish divergence. That's sort of what's on watch there. I color code the cumulative advanced decline lines based on just subjective look at these trends and whether we're making higher highs and higher lows or the opposite. I color coded a couple of these orange last Friday as they'd broken down through their 50-day moving averages. All of them now have reverted back. These aren't quite updated for today's close, all of them yet. I would not be surprised, though, if all of these have made new highs once all is said and done, and confirms certainly the breadth very supportive of the recent move. One of the challenges the market has had as it's gone higher over the last month has been a declining number of new 52-week highs. So the market going higher, but less and less individual stocks making their own 52-week highs. And it really disappeared last week. You almost went to zero. That's all starting to increase. And again, we don't have today's reading just yet, but it's been increasing more and more through the course of this week. So an expansion in new highs, especially going into next week, is something I'll be looking at just to confirm that there is a broad advance. It's not just a smaller number of stocks. Interesting sort of good news, bad news from the percent of stocks above their moving averages. This is something we use regularly to measure overall market participation, right? How many stocks are above their moving averages. Down at the bottom, it's the percent of S&P names above their 50-day. One of the things we highlighted in mid-January, late January, was the higher highs in price, but how the indicator was trending downward, suggesting less and less stocks remaining above their 50-day as the S&P was doing so. That indicator went below 50% for the first time since last October. This was in the market sold off last week, bottomed out just above 40%. Since then, it's gone back higher, and it closed almost at 68% of the S&P above their 50-day moving average. So that's actually pretty constructive, the fact that it's gone from 40-something up to 60-something. But what's interesting to me, think of it a different way. At the peak here at the end of last year, about 87% of the S&P above their 50-day. Now it's about 68, 67%. So 20% of S&P names then, hypothetically, were above their 50-day, broke below their 50-day, and have not gotten back above them. And that's a bit of a concern, right? So that means the market's rallying, making new highs back above its 50-day, but about 20% of the S&P has not participated in that recovery yet. So it'd be interesting to see if that line continues to go higher. I think that would further validate the potential for new highs in the S&P. Sentiment we talked about pretty deeply yesterday, so I don't want to beat it too much, but pretty much mixed, even responses between bullish and bearish on the AAII survey. The name exposure index back to what I would call a healthy bullish. It's not euphoric. It's more constructive. It's more optimistic, I would say. And so that's good. I mean, I think if you're bullish on stocks, you don't want to see extreme bullishness on some of the sentiment readings, because what that tells you is the anecdotal last buyer has participated. That's what creates the conditions or reflects the conditions that there's no one left to push the price higher. That's come off a little bit. So basically suggests there could be further upside. The other part of that, though, the RIDEX flows, which looks at flows between, bullish, what you'd consider bullish funds, things like sector funds, index funds, and traditional offense versus defensive money market sort of funds. It's 0.1%, which is an extreme low level. It's an all-time low. We're on this chart, which is inverted, sort of the highest peak that it's been. So, overall, it's suggesting still at a euphoric stage. Offense still outperforming defense when you look at consumer discretionary versus consumer staples. Semiconductors a bit of a concern. So this ratio is rolling over just a bit. It's not the end of the world yet. It's not really breaking down through any trend lines or anything, but something to watch going into the next week. Today, as you saw, technology underperforming the market, semiconductors underperforming as well. And that's not the scenario that tends to be a good signal for the overall market. Having said that, again, consumer positive, small caps continuing to outperform large caps as we finish off the the Mindful Investor Live chart list. The equal weighted S&P has come off a little bit. You can see the last week, you'd expect it maybe to be outperforming because it's been doing so well, but it's actually pretty even, which means the mega caps have been holding up okay. Growth continuing to outperform value by any measure that we would do it in the last couple of days. High beta coming back up versus low volatility. US strongly outperforming global stocks in the last month. That's with the dollar popping up a little bit. EM continuing to outperform. EFA, meaning emerging versus developed markets, and stocks over bonds. Nothing on this chart telling me that that's changing anytime soon. That is our Wrap the Week segment, hitting on some of the key charts, price, breadth, sentiment ratios. I hope this made you think a bit about your perspective on the markets. Let's take a quick break. Back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close, and it's been a real pleasure to hear from so many of you as we've been doing the show. Feedback on the show, which we always appreciate. Feedback on our guests, which we definitely appreciate as well, but also questions, and that's where I hope we can be of help to you as you navigate the markets, as you manage your portfolio, think about your trading plan. Anything to do with charts, please let us be a resource to help point you in the right direction. Shoot us any questions that you have via email, thefinalbar@stockcharts.com, on Twitter @finalbarsctv, on our YouTube channel. Number one, give us a follow and subscribe to our channel if you're up for it. But also a video that you're watching, just put a comment right below that video, and we'll capture all of those questions. We'll do another mailbag segment on Tuesday's show, beginning of next week. We'd love to answer one of your questions on the air. Let's get to it. Open the Final Bar Mailbag. Question number one, great show, David. As a layman, I know these stocks like GME have gone up too fast in a steep line. This is actually from when these things are going vertical. So sorry I didn't get to this question earlier, but we'll get to it. We'll get to it now. How do we confirm a left half of a V, like an inverted V formation? And it's a really good question. And as I mentioned, I think when a stock goes up like this, there are a couple things that I would tell you about. Number one, one of the things I learned earlier in my career, there is a lot of money to be made on the left side of bubbles. When things sort of show bubble characteristics, it's very easy to sort of feel like you missed out and to get out of the way and just ignore it until it changes. And money managers I worked with taught me that on the left side of bubbles, as euphoria is building, as optimism is getting extreme, things go up. And if you can participate and manage your risk effectively, it actually can be a really good opportunity. But it's all about defining your risk. And remember, most trailing stops, most money management tools using the technical toolkit are built on things like the trading range, the average true range, volatility. And this is ways of recognizing when something's more volatile, when the moves are more extreme, your stop needs to be adjusted as a result of that. So what I would basically assume is when you have something that moves like this, keeping sort of a stop that that will make sure that you lock in whatever profits you're hopefully gaining, I think would be really, really helpful. So, as you bounce up, using the previous day's low, using the low from the previous week, using, some way of locking in gains would be ideal. In terms of how else can you determine that a left side of this thing, are things getting exhausted? For me, if I open up, where are we at here? I'm going to open up ACP, which is our advanced charting platform. I actually created a chart list called The Big Short, not suggesting by any means that these are short candidates, but it was just to sort of group all these stocks together. And I usually look at them in order and see how they're doing. GameStop, by the way, popped up pretty well today. Is up 20% today. So this is the chart of GameStop right here. And the reason why I'm bringing this up is if you look at the candles, look at what happened recently. After you had this big run up, this is the first concerning candle. It's called a doji candle, probably, I guess is what I would call, where the open and close are nearly identical, and you have the real body, the high and the low in the background. Then look at this cluster of solid candles. So that means is every day, regardless of where you close relative to the previous day, the close was below the open every day. That cluster of down candles tells me, even though we're jumping up, we're distributing. People are distributing shares during the course of the day. That is not what an extended bull phase is usually made of. So at that point, that would start to tell me that maybe we're entering, we're sort of getting to the end of that left side of that upside down V. And sure enough, since then, it's been solid candle, solid candle, solid candles. Today, maybe the first day you see a potential bottoming formation, or you might call that an inverted hammer, I guess, sort of an inverted candle with a long upper shadow, minimal lower shadow, in the open and close relatively close, happening right at the 50-day moving average, by the way. It might mean a bit of a bounce for GameStop next week. We'll have to see. The changes in the structure of how people could trade GME certainly impacted that. So that is what I would look at overall on stocks like that. It is a challenge for sure. Next question. Love Tony's work. This is from earlier in the week, Tony Zhang, and I agree. I thought he did a fantastic job. We'll certainly look to get him back on the channel sometime soon. On January 28th, the S&P reversed lower after pulling back to the November low trend line. This is considered resistance, but another TA I respect, technical analyst I respect, isn't mentioning it either. Am I missing something? Let's see what you're actually looking at here. Let's look at a daily chart of the S&P. You're saying on January 28th, which is sort of right here, we reversed higher after pulling back to the, right here. So yeah, I guess you're talking about, we had this trend line, which I've drawn here in the pink dashed line. We sort of broke down, and then we traded back up to that. And this is considered resistance. So here's the way I generally think of trend lines. You use a trend line below the prices when we're in an uptrend, right? So when the prices are going higher, you already know they're going higher. You use a trend line to determine when that trend is broken. Once that happens, I tend to ignore that trend line and sort of think we need to recalibrate because the trend is now different. A trend line for me is a visual gauge of what's happening. Once that trend is broken, it's no longer super important to me, and I'll try to draw a different trend line that represents the new state of the market. Same thing in a downtrend. You don't need a line that tells you that the stock is going down. You don't need a trend line down here necessarily. You more need it on the highs, because you want to know when that downtrend is over, and you see that when it starts breaking the trend line from below. So I probably didn't key on too much about that, because for me it's not as important of a level. I'm more concerned with the fact that we broke it, and that's what tells me that the trend line is no longer key. I hope that answered your question. If I missed it, I apologize for that. Next question, let's see. I've seen some stocks touch their 100-day moving average and return. Is a 100-day moving average an important benchmark, or 200-day moving average? Thanks. Great question. So there are a lot of different combinations people use. If you look, when I bring up any chart, just bringing up a random chart, any chart I bring up, it has two moving averages, the 50 and 200-day. I started using those when I first learned technical analysis. I was at Bloomberg, and that was the default moving averages that pretty much every user had. So I saw a bunch of institutional investors managing tons of money that were looking at the 50 and 200-day moving averages. So for me, that was about enough to convince me that it was worth paying attention to them. There was something we said, yeah, I've seen people use the 20-day, the 100-day, the 400-some day, the like 425-day. I've seen Grayson Rose, Gaddis Rose use. There are no shortage of things. I've had extended philosophical debates with guys like Arthur Hill and Chip Anderson, our founder, about exponential moving averages. And to be honest with you, I think at the end of the day, picking some combination that makes sense for you and arguably that you use consistently is what's going to be most important. As I mentioned before, I think a consistent, imperfect process is way better than a perfect, inconsistent process. The consistency and using the same thing over and over and knowing how your charts are relating to those moving averages are pretty key. So for me, it's the 50 and 200 day. That's what helps me make sense of the short term versus the long term. I would encourage you to find the combination that works for you and focus on that. Oh, next question was actually a little later. Said Tesla. I was noticing the scooter ranking for Tesla. Tesla's not touched its highs in the past 3 weeks, but the scooter stays above 99%. How is that possible? I thought the scooter rankings would come down. I mentioned this a little. I might have addressed this earlier in the week if I remember. Yet NIO, Tesla are two of the top ranked names, and both of those have kind of come off a little bit. Totally fine. The thing that gets the scooter rankings, or the way that they're designed, is they have a short-term, medium-term, and long-term component. The long-term component is the heaviest weighting, which means something that's still up pretty good over the long term is still going to score very well. I actually find that pretty helpful because otherwise there'd be a ton of movement in the rankings. It would be hard to keep sense of because it would be very driven by the short-term movements. I actually like the fact that it's a little more focused on the long term. Next question, curious as to why the recent trend line drawn with only 2 price points would not a trend line drawn from November 5th. And I don't have your chart, but I can show you on my chart kind of what you're looking at. You basically said my trend line, which is this one, only has a couple points that you started with. Why is that not as good as something like this? And I will draw in a, let's see, a thicker green so you can all see it. You're basically taking this point and saying, what about this? Because this is a better connection to more points. I totally see the argument of that. For me, I tend to pick the extremes. I start at the extremes and go from there. But if you think about it, coming out of the March low, if you drew this trend line, that's not super helpful because there was such an acceleration off the lows. If you take a secondary low, something like that, I'm totally butchering these, I'm so sorry, but just for point, if you take some of these secondary lows, it's actually a much better representation of what the price actually does. So I don't have a problem with that. I see what you're saying, and it reminds me a lot of financial stocks coming out of the 2009 low. They sort of bounced off, did that V bottom, and then sort of settled into a shallower but consistent uptrend. And that was the time. What we basically did was ignore that, that first low and pick the second low, and that was a much better measure of the trend. You may actually be right. And so far, it looks like your trend is holding up much better than mine in terms of the overall configuration, though. But for me, when I first learned technical analysis, it was pick the extremes and go from there, and that is where I tend to go back to. That's all the time we have for the questions. I want to thank you guys so much for sending in those very thoughtful questions, sharing some charts along the way, which helped me see what you were doing. Keep your questions coming. Shoot us an email, the final bar at StockCharts.com. We'd love to answer your question in our next mailbag segment. We need to wrap the show. 3 charts, 3 minutes. Here we go. We're going to start with this ratio. This is from our Mindful Investor Live chart list, consumer discretionary versus staples. This comes from Bill Doan, who was one of my predecessors at Fidelity in the the 1980s, maybe the 70s before that. Looked at offense versus defense, had a bunch of charts in our chart room that focused on this relationship. And this is the latest way we had come up to do that, which is looking at consumer discretionary over consumer staples on both a cap weighted and an equal weighted basis. Both of these are making new highs this week. And overall, that is saying, keep your foot on the accelerator. The market's going higher. Chart number 2 in our 3 and 3 is small caps over large caps. This is just the ratio of one divided by the other. You can see that small caps really outperformed coming out of the March low. June through September of last year, they were sideways. And then from October on, starting in the 3rd quarter of last year, it has essentially unabated been an uptrend outperformance of small caps versus large caps. This is not just financials and energy doing okay. This is a broader expansion of the small cap universe versus the mega caps, basically, is what that ratio is telling you. So overall, it is suggesting continue to stay in on small caps, look opportunistically down the cap tiers. Finally, just to highlight one group breaking to new highs, home builders. We've talked about this group before, really had a nice rally into the October high. The ITB, a lot of the individual names sort of had a sideways period, now rotating higher. This looks a bit like a cup and handle pattern with a shallower pullback, the shallower rotation here, and then a break to new closing highs for Lennar. Further upside potential there. Folks, that is a wrap for this week, a wrap for the show, the final bar. I want to thank you so much for joining us every weekday after the close to break down the markets together. For StockCharts.com in Redmond, Washington, have a great weekend. We'll see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.